Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The price war in the EV space that began really late in 2022 continues in 2023. We just had another major competitor, NIO, announce that they were reducing prices. This follows Tesla cutting prices pretty dramatically earlier this year. And I don't see any sign that this price war is going to end anytime soon. We have still not seen a lot of the legacy auto manufacturers ramp their EV production. And at the same time, a lot of these new startup manufacturers continue to expand production at an extremely rapid rate. Tesla itself is growing 50% per year. So as all this supply comes onto the market, you have to have demand to fill that. I just don't see demand growing in the same way. That's what the numbers tell us, but that's what I want to get into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, in the show notes below if you're interested in disruptive companies like those in the EV space. Now, I want to start with a few headlines and reports that we've seen. This is the one from this week. Monday, NIO announced that it was going to be cutting prices for its cars and then cut back on its expansion plans. This is after gross margins dropped pretty significantly, something that we've seen at other competitors like Tesla as well, which I'll get to in a second. But seems like these price cuts are not going anywhere anytime soon for a lot of these EV manufacturers. You might remember that XPeng cut their pricing by up to 13% earlier this year. This is an article from January. We have seen Ford cut prices and obviously Tesla as well. I want to show some interesting data that came out from Cox Automotive this week. They do a study on car pricing, and the one outlier here, I'll just expand this chart. You can see that pricing was actually up for most automakers. BMW, Daimler, Ford, Toyota's over here on the right, up 10.9%. The one outlier, Tesla, down 13.6% year over year, and even down slightly month over month. Here you can see this data in table form. This is Tesla's numbers right here, down 0.1% month over month and 13.6% year over year. The month over month number is in line with some of the other competitors. Some are down, some are up. So kind of all over the board. But the huge drop in prices year over year is really telling us where we're going with this price war. The impact this is having on financials is really where I want to focus, because these are manufacturing companies. They're making a hard goods product. They have operating costs that they need to cover month after month. You need to make money on each product that you sell. And the less money you make on each sale, the less profitable you're going to be long term. That's the reason that auto companies have typically not been very good investments long term, is that if demand dries up and you have a factory that's not actually producing anything, or pricing goes down and you're making less money on each vehicle, you suddenly get into a really tough financial position really quickly. So growing production extremely quickly is actually very risky for these automakers. You can see from this chart here that Tesla's revenue per vehicle actually peaked in Q2 2022 at $57,331 per vehicle. This is revenue excluding the credits that it gets for zero emissions. So that's not really a sustainable revenue source. So I just pulled that out from all of these numbers that I'm going to cite here. But revenue, $57,331 per vehicle. A year later, Q1 2023, that number was $47,207 per vehicle. Gross profit per vehicle, remember, excluding those credits, has gone from $15,675 in Q1 2022 to $8,719 in Q1 2023. So nearly a 50% drop in profit per vehicle. And that's not even including some of the most recent price cuts that we've seen from Tesla. So profitability gone from 28.8% to 18.5%. That's a really significant drop from a gross margin perspective and is going to put more and more pressure on the bottom line. A lot of these numbers that I focused on here were from Tesla because that's the biggest automaker. It's the most established EV automaker. But actually the smaller automakers, the financials are often much, much worse. I didn't mention Rivian here, but they're going to be reporting major losses this year. And it's not clear if they have enough demand to fill even what they're going to produce just in 2023. Lucid is in a similar position. And at the same time, all of these companies are extremely valuable. Tesla is one of the most valuable companies in the world. Right now, I think what we're seeing is that supply continues to increase extremely quickly. Demand is not growing as quickly. That means that we have pricing coming down, margins coming down. And as a result, these companies are going to be less profitable in 2023. And don't forget, the legacy automakers are increasing their EV production this year, next year, the year after. So there's going to be more and more pressure coming from a pricing side in the EV market. I think this is just a space that investors should stay away from. There's too much risk. The operating trends are moving in the wrong direction. And I don't see any value in any of these names right now. I could be wrong, but this is what the numbers are telling me, and this is what the pricing is telling me. What do you think? Leave your comments in the comments section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.